All right, welcome to the Monday edition of On the Tape podcast. I am Dan Nathan. I am joined by Liz Young. Liz, welcome this morning.
Good morning.
We got a lot to do today. Big week in the markets. I kind of feel like this is kind of a make or break week, Liz. There's lots of talk about, what sort of rally, the one that Guy will refuse to say on a podcast, but it has something to do with the holiday season here in the S&P 500.
The big guy who wears red.
Yeah, that guy. There's lots and lots of chatter about that all weekend long. Every time I open the wallstreetjournal.com, there was an article about the stock market revving up into year end and FOMO and the like. So we're going to talk all about that. We're going to talk about some inflation data that's coming out this week. We're going to talk about what is, I think it's going to be a massive meeting between President Xi of China and President Biden here on Wednesday. We do have some retail earnings. There's so lot to talk about. But first, a little housekeeping. Stick around after this conversation. That would be myself with Liz Young, EY from SoFi. We have Ali Melli. He is the founder at Momentary Capital Partners, and Guy and I had a great conversation with him about everything going on in the credit market, specifically private credit, and his thoughts on the macro there. So you're not going to want to miss that. And also on Friday's podcast, On the Tape, that dropped on Friday. Check that out. We had Halima Croft on. She is the head commodity strategist at RBC Capital, and we had a great conversation, everything in the oil patch and beyond, geopolitical and the like, and so you don't want to miss that. Also, we had the CEO of Team Rubicon. That would be Art Dela Cruz, great friend of the pod, founded by someone that you know also there, Liz. That would be Jake Wood. This is a nonprofit started by Jake, run by Art Dela Cruz. They train vets and they deploy them to disaster areas. We were doing a giveaway for an On the Tape hat, the first ever On the Tape hat. If you gave $25 or more to Team Rubicon, and we've already had so many people give. We really appreciate that. We are doing a big match on that one too and giving away hats. So go to the show notes. You know what to do. Send a minimum $25 donation to Team Rubicon. Send it to contact@riskreversal.com. That would be a screenshot, and Amanda will send you a hat. So we really appreciate all the participation there. That is a great organization. All right, Liz, let's get to it here. Are you feeling the FOMO? Is that kind of working in a little bit here? And I know you're seeing it on the Twitter, you're seeing it in the financial press, but here's the thing. Okay. And we can talk about what's happened over the last couple of weeks since that November 1st Fed meeting and since what happened with the auctions and the size of them, right? And we saw yields come in, stocks, the S&P 500 shot up about 7%, up 9 out of the last 10 days or so. We know the Mag 7 makes up nearly 30%, okay, of that S&P 500. Microsoft just closed at a new all-time high. Remember, the last time it was trading here, Liz, was in July, and the stock then had a 15% peak to trough decline. So it just seems like yields in, the Fed dovish, okay, animal spirits taking over investors. They're going back to the things that worked most of this year. How are you shaking out here? Because the 10-year did bounce off of that 4.5 level and actually feels like, based on maybe some of the inflation readings that we could get this week, that they could move higher. Is this rally, is it on shaky ground?
Well, I mean, I think we've thought it was on shaky ground all year. But here's what's happening right now. First of all, we've got, yes, the 10-year moved higher, but it's 35 basis points below that 5% mental threshold that everybody got really freaked out about. So we're pretty squarely beneath that. And I think, I mentioned this last week, this is sort of rational behavior for the market. Yields come down, the cost of capital, the discount rate comes down, things feel a little less pressured from that perspective, and stock prices rallied. So in the meantime period, I do think that the market can probably find more upside. Do I think it's lasting and durable based on fundamentals? No, but I do think that it can find more upside. We have CPI and PPI coming out this week. CPI, much more of a market mover, headline maker than PPI, but both important to watch. The things that, as we know, will be looked at more closely in the CPI read is headline CPI, and that is expected to come down quite a bit. 3.3 is the expectation. Even if we overshoot those expectations, it's still a downtick in that reading, and I would imagine the market will fixate on that if that's the case. So if we get a 3.3, the takeaway will be CPI is cooling, inflation is getting under control, things are good. I wouldn't be surprised to see a rate cut the probability of a rate cut increase in June, that sort of thing. And that will probably be met with positive sentiment from buyers and people that are trying to buy the dip or have that FOMO trade waiting in the wings, just looking for a reason to pull the trigger. So I do think that we're going to see that this week. The thing that is still looming out there is if you look at core CPI or core PCE, core CPI is not expected to come down at all this month, expected to stay at 4.1%. Core PCE still at 3.7%, expected to stay there through the end of the year by the Fed themselves. So this inflation thing is not over. The Fed, I think, has been interpreted as being dovish. I actually don't think their messaging has been dovish. So there's a disagreement in the market with what the Fed is saying and what the market is actually reacting to.
Yeah, well, it's interesting though. It was the market reaction to the Fed meeting, right? And the auction sizes that caused the S&P 500 off of, like we could all agree, I think off of a pretty oversold condition a couple weeks ago. Sentiment was really bad. We were coming out of, earnings season. That was like, let's say mixed. I think the results were fine, but we saw plenty of situations where when companies missed and not even by a whole heck of a lot, Alphabet was one of them. The guidance was a little murky. I mean, the stocks got slammed. Now that changed a lot after that November first meeting or so, but it seemed very obvious that Fed Chair Powell wanted to throw a little cold water on the rally with his commentary late last week. And David Rosenberg had a comment in his note this morning, which I thought was kind of interesting because he basically said that the stock market shooting up 7%. That's the sort of situation that the Fed does not want to see financial conditions ease too much, right? Like in reaction to one comment. And so that's why some of that Fed speak late last week kind of changed the tune a little bit. But it's funny, when you think about just how quickly the stock market has come back, right, to this 4,400 level in the S&P 500. The prior high in July was about 4,600. If we were to get back there, Liz, okay, and I think that's where a lot of folks who kind of see a year-end rally, that's 12% that would feel like in a straight line. And then you got to go all the way back to the first week of January 2022, right, when we were making new all-time highs up there at 48. And I guess the issue that I have is that we will be climbing a wall of worry because like it's not like the fundamental data, it's not like the economic data right now that's giving the Fed reason to be a bit dovish or at least perceived dovish is like emboldening of a broader rally across the stock market that's based on like some sort of better economic activity. And I got don't have to go much further than why this meeting on Wednesday with Xi and Biden is so important because the data out of China is really bad. And the irony is that both of our countries just reported GDP of about 4.9%, but the economic data aside from that print seems very, very different, right? Like speak to that a little bit and the importance of, Xi and Biden meeting on the US soil here. And there was an article in the Wall Street Journal kind of previewing the meeting, just suggesting that both of these leaders have massive incentives to keep things on the rails right now from an economic perspective.
Yes, but for different reasons. China's in a completely different trajectory as far as economic data, as you just mentioned. The other thing is, keep in mind what categories these two countries fall in, right? The US being the most developed country in the world, a 4.9% GDP print is blistering hot. Usually, a very developed nation, you expect to grow somewhere in the 2-ish percent range. 2 to 3% would be healthy. And that's good growth because we've already done all of the growing. An emerging nation with a 4.9% GDP rate is actually pretty disappointing. That's a slow rate. You want to see emerging nations as they're coming up and maybe transitioning from machine led to services led, right? All of that stuff changes and the growth rates are usually much, much stronger. So, coming from just those categories alone, we've got two countries in very different places. The US trying to protect the growth that is here right now and trying to protect consumer spending that's happening. Although there's some cooling, we're trying to make sure that we can maintain a growth rate. China trying to create a growth rate, right? Trying to pull something out of a hat a little bit. So I do think there's a lot on the table for both countries, for both sides of this. And it just goes to show how intertwined we still are as nations and how intertwined our trade is and how much each economy depends on the other in direct ways and indirect ways. We've got A lot of companies in the US that had been looking to the Asian consumer to hold up their sales for a long time, and that's been pretty disappointing over the last year or so. So there's a lot at stake here, and then add on top of that just the layer of geopolitical risk and tension that exists in the world. The last thing we need is an increase in tension between us and China.
Yeah, it's interesting. There was in the FT this morning. There was an article, a poll that the FT ran with University of Michigan Ross School. Only 14% of U.S. voters say Biden has made them better off. The new poll results showed that inflation continues to cloud the Biden campaign's efforts to convince voters Bidenomics, the president's strategy to rejuvenate the country's industrial sector and reverse years of middle class wage stagnation. And so, like, they're basically going on to say that this is probably one of the lowest readings 1 year out for an incumbent president on that. So going back to the incentives with China, right? And again, there's two things at work here. What's going on from a geopolitical standpoint, and they're kind of leaning towards aiding Russia in the Ukraine war, and obviously Russia now aiding, right, and being aligned with Iran and their proxies, and what's going on with Israel and the Gaza Strip. You know what I mean? Like, this is all has the potential to kind of merge into one nasty sort of thing. And again, I'm not trying to put my political science hat on. It's just kind of what I read here. But on the flip side of that, maybe all the economic stuff and the worries that she has right now, and obviously Biden and becoming, reelected and the like, maybe we can keep things on the rails, right? And maybe this kind of, you know, this kind of softening of relations is the sort of thing that might keep the Chinese away from some sort of provocation with Taiwan. Now, Liz, this is interesting though. This morning in the journal, in all the papers, they're talking about, might China start ordering Boeing 737 Maxes again, and this and that. These are the things that will come out of a good summit, right? Where both of these countries basically say, we've been priming the pump. We sent Secretary Blinken, we sent Secretary Yellen, they've had people over here. This has been going on for months. Let's just say we can kind of have a little bit of a détente from an economic standpoint, and then put some things in place that would give, I guess, both countries a little confidence that we are there for each other economically, at least in the meantime.
Well, and that the flow of trade isn't gonna completely shut down, right? And that we're not increasing sanctions and we're not putting more restrictions on, that there's still money moving between the 2 countries, and I think both would like for that to happen. We still do need some trade to move back and forth. I don't even after this week, it's not as if we're gonna come away from this week and say, "Okay, all the problems are solved, everything is fine, the relationship is perfectly intact, and we can all move on our merry way." But it would help to have some increased purchasing, some increased activity, and maybe just a lowering of the nerves and the trepidation about what this could look like if things got worse or if more restrictions were put on from China on US companies.
Yeah. It's interesting. And we go back 4 years ago, during the Trump administration, it seemed like every day, there was kind of a new salvo on this trade war, right? And all the tariffs. And, the interesting thing about it is a lot of those tariffs are still in place. I feel like the mood is probably as bad as it's ever been as it relates to China. And there really is possibly an opportunity with their economy, to your point, far weaker than ours, and some of the issues that they have going on in their credit markets and their real estate markets. And it's interesting to note that we talk about the wealth effect here in the US, and it's tied to a whole host of different factors, the stock market, real estate. Over there, it is squarely tied towards real estate. So problems in the real estate market really hit the consumers there. So that's one, obviously, to keep an eye on. But you mentioned, one of the reasons why the stock market has had this run over the last couple of weeks or so, a lot to do with just kind of interest rates, or at least the mood, or the, towards the potential for them to go much higher, has dissipated, right? And so I just think it's interesting. You also mentioned the potential for rate cuts, and we know that that's been a moving target over the course of the last year. I don't think many folks a year ago thought Fed funds was going to be at the upper end, 5.5%. So Goldman and Morgan diverging on how quick they expect rate cuts to happen next year and where they expect to settle out. If you look at the Federal Reserve, they expect by the end of 2025 to have this 5.5 Fed funds down to 3.9%. Morgan Stanley expects it to be 2.375, and Goldman Sachs between 4 and 4.25. So Goldman is in the higher for longer sort of camp. That is a huge delta by two of the largest investment banks here in the US. And so when we think about the input of rates and the perception of on equity valuations, right, Liz, that's a big divide here. How are you shaking out? And again, we've spent a lot of time talking about this. When the Fed starts to cut, it might be because this uninversion of the of the yield curve puts us into a recession and things get weaker. And again, we just talked about climbing a wall of worry. There's a whole host of reasons why the global economy could weaken. Might they start cutting aggressively for not good reasons?
I do think they're gonna cut before long before the end of 2024. Also, okay, let's keep in mind here, these 2 forecasts are for the end of 2025. We're talking about 26 months in the future. That is a very, very long time. Things are likely to change tremendously between now and then, and I can almost guarantee that both of those forecasts will change. Maybe some of them will even get higher, I don't know, but both of those will have to change before the end of 2025. So, it's really, really difficult, if not impossible, to try to predict out monetary policy moves that far into the future. The Fed themselves can't even predict out monetary policy moves 6 to 12 months out into the future. So I wouldn't put too much stock in the actual numbers that they're putting out. It's the path that I actually found more interesting about this whole story. I believe, and correct me if I'm wrong, I believe the Goldman forecast was that the Fed wouldn't even start cutting until the end of next year or maybe early 2025, which means that the Fed funds rate stays at this level. That's actually a bullish call on the economy. And I think they also had a prediction of the unemployment rate moving back down at some point over the next 2 years. So the Goldman call is pretty bullish on the economy and assuming either a soft landing, no landing, or that we just completely skirt by recession entirely and end up growing again. That's the part that I struggle to see as most likely, just because we've already got some cooling that's happening.
So that's a really great point. So in the note, they actually suggest that they've always been in the soft landing camp. They believe that's what we're kind of getting right now at, the worst case scenario. That it almost seems like a no landing scenario. Why do you perceive it as bullish? Why wouldn't the Fed be able to lower interest rates prior to Q4 2024 if there is a very soft landing? Do you understand what I'm saying? Because to me,
Yes. Okay.
doesn't that kind of
Sure.
keep the shackles on the economy to some degree?
Yeah. Yes. So perhaps not bullish on the inflation picture because that it must assume that inflation still needs to be controlled. So we have to leave rates higher. What I perceive it as bullish is because it's the assumption that the economy can withstand rates that high and then pair that with the unemployment rate actually coming back down. So if you expect rates to stay that high and not predicting some sort of recession or a big pullback in the market, plus the unemployment rate coming back down, that assumes that the economy is strong enough, growing strongly enough, company fundamentals are strong enough that hiring actually picks back up again at some point before the Fed even lowers rates. I see that as a pretty bullish call on economic growth and just the US economy overall. The idea that the economy and companies can withstand higher rates is the part that I struggle with. I think we've withstood it pretty well so far. I don't think we can withstand it for another 12 to 14 months. We're already seeing a lot of issues pop up in some of the smaller areas, things like subprime auto loans at their highest delinquency rate ever, right? Those sorts of things that are popping up in the more stressed parts of the market, but over time that spreads out into wider areas. And I do think that in order for companies to maintain margins as expected, they're going to have to cut costs. And those costs cuts are going to come in the form of labor cuts. So the idea that the unemployment rate would actually come back down is hard for me to do that math on in my head.
Yeah, it's interesting you mentioned on the consumer front, delinquencies, auto loans. We're going to start seeing more and more foreclosures in probably commercial real estate, which would all obviously to me, you're going to see more stress in the housing market and the consumer market too. And so those are the two things that I'd kind of keep an eye on. I just want to go back to that FT poll for a second about Biden's job on the economy. Here was a quote from the article: in response to inflationary pressure, 65% of voters said they had cut back on non-essential spending, such as holidays or eating out, while 52% said they had reduced spending on food or other everyday necessities. That's not a good data point right there for the consumer. We've been talking about it a lot on the pod over the last 6 to 12 months or so. Talk to me a little bit about where you see the consumer. We had data last week, University of Michigan. You tweeted about it. We'll put it in the show notes. Came in worse than expected here. Anecdotally, I'm starting to get like holiday, email. I mean, it seems like it's going to be a very promotional retail season. We're going to get some retail earnings over the next couple of weeks too. Thoughts here on the consumer, especially at a time where we're looking at CPI, we're looking at PPI, and we can explain it away. If we still have a 3 handle on CPI, well, that's a lot better than the 9 handle that we had a year and a half ago or something like that. But it's still 3% year over year off of those elevated levels.
Yep. Yeah, there has been no negative print yet in the inflation data, which means that prices are still high. They just stopped growing as fast. So, a few things about this. These are the under the surface inflation readings and things that I think people need to remember and think about. When you look at the PMI data that's come out so far in November, we had PMI data on manufacturing and services, both disappointed versus expectations. And there's a component in both of those surveys called prices paid. The prices paid component both came in above expectations. So, that indicates that you've got businesses still dealing with high inflation down the supply chain. So that means that their margins are going to be under pressure because they're still having to pay for inflated prices as they make their products or as they create their services. So that's thing number one. The other thing, more recently, as you pointed out, the University of Michigan survey that came out last week is inflation expectations. So not only did the survey data miss on a top line basis, but the inflation expectations component is measured both over a 1 year period and then a 5 to 10 year period. Those both ticked up and not just a little bit, they both ticked up a decent amount. So that's consumers saying that they expect inflation to be a problem, if not a bigger problem than it is today, over the next 12 months and 5 to 10 years from now. So as consumers expect prices to stay high, particularly for a long period of time, that's where you start to get into this issue that the Fed had talked about quite a bit. They haven't said much about it recently, but into this issue of inflation becoming entrenched in the economy. And that's where you really run into problems. I think one of the things that Powell keeps saying is that if prices are not stable, or if we can't maintain stable prices, the economy doesn't work for anyone. And that's still true. The thing that would be the biggest problem is if inflation became entrenched. The way that they measure that is by inflation expectations. So I think the most concerning part of that survey last week was that expectations had moved up and consumers are not feeling as promising about the prospect of inflation falling, particularly falling and staying down as time goes on.
Yeah, and I always find this period in mid-November really interesting where we have all these major box stores reporting earnings right before Black Friday, right before the big holiday season and some of the things that they are expecting. And we know that it's been, a kind of seesaw, couple years for a lot of these folks who had to deal with inventory issues, coming out of COVID. And now, just the dispersion between some of these real the dispersion between some of these retailers is just fascinating. Walmart's trading an all-time high where, Target has been cut in half and some of it's their exposure to food pricing and some of their exposure to apparel and inventory issues and the like here. So to me, this is going to be a really interesting, couple weeks, especially as we head into the holiday season with expectations right now firmly in the camp that we are going to rip into year end. Liz, as you think about.
What hold on, one thing I wanna say about retailers real quick, just for people to keep an eye on. As somebody who shops and enjoys shopping quite a bit, I've got a good pulse on how things change over time, and you usually have brands that you're more familiar with. What I think is starting to happen, and actually just today, and this is all anecdotal, but when brands that don't really ever put their things on sale start to run sales, it's them trying to stimulate demand, right? It's them trying to do that whole the volume thing. They need more volume in order to maintain sales at a certain level. How do you get volume? You cut prices and do an enticement for a short period of time. So there's a particular brand, and I ordered something today because they never really run sales, and they had a 25% off sale that's going on for the next 10 days. So I bought something. It worked, right? Hook, line, and sinker. But either way, when you start to see brands running discounts that you're not used to seeing run discounts, you know that demand is probably softening, or they have inventory that they need to unload. They've overestimated the amount of inventory and they need to unload it. They're trying to get rid of it. So yes, I do think it's gonna be a very heavily promoted holiday season. I think it's gonna be fascinating to find out whether or not consumers actually step up to the plate and buy the stuff that's being promoted, or if this is finally gonna be the time where we see that even holiday spending was weaker and people are pulling back.
Yeah, I suspect that some of the trends that we've seen from, consumers that they will step up to those promotions, and could be the death rattle, I think, for this kind of cycle of consumer splurging. But Exhibit A for what you just described is what's happened in Tesla over the last, year and a half. I mean, they've cut prices 6 or 7 times. That is not something you expect from a large auto company, especially one that has the market share that they have in their main market in North America, and the stock has performed very poorly since they started cutting prices, I think about 18 months ago or so. So like that is a really, that whole idea of price elasticity, it works until it doesn't, until it becomes again entrenched, like we were talking about inflation. And the last point I'll just make is that that's going to really hurt margins for a lot of these companies, right? And when we think about S&P expectations for earnings in 2024, they're really rosy, up double digits. And they've been coming down a little bit. We've been quoting the FactSet data, but not a lot. So when you think the further stocks run right now, okay, and S&P earnings remain steadfast, yet we see margin pressure all over the place, that disconnect is the thing that has the potential, to me, to turn into a very sharp sell-off. And so I think the higher we go into year end is probably the harder we fall in the new year. So that's my 2 cents there. Liz, any sectors you want to be focused on? Let's just say we are going to make a move back towards 4,600 in the S&P 500, away from the leadership. And just to be very clear, I don't know if you saw the SMH on Friday was up 4%. That's the ETF that tracks semiconductors. Nvidia is very near its prior all-time closing high, just above $500. They report next week. That's going to be one on the radar to me. But semis have come back. Intel's very near a 52-week high. That's a stock that was in the doghouse. Taiwan Semis had a massive run over the last couple of weeks after being down more than 20% from its highs over the summer. So semis, very cyclical. I'd say bullish, right, for the broader economy, but there's a lot of other very cyclical areas of the market, energy, industrials, transports, that don't act particularly well.
Yeah, well, so if we do continue this run, it's more likely to be on the heels of rates continuing to come down, in which case I think you hear the same old story. Growth stocks see a revival. Consumer discretionary stocks, I don't think are going to really come off the mat too much, just because there are a lot of concerns about the consumer, and we keep hearing rumblings about spending coming down, much of which we've already just covered on this podcast. So discretionary might be the spot that doesn't participate as much in a growth led rally, but those big tech stocks that took it on the chin since the end of July, I think they probably still can do well. And we talk about the FOMO trade. I mean, generally, we're talking about individual investors, right? Retail traders in that FOMO trade. And we know that individual investors do buy the Magnificent Seven stocks, and particularly younger investors, too. If you look at just the appetite and the people that are out there active in the market, we probably see a bid for those, and the FOMO trade benefits that. The thing that I think is interesting to watch through the end of the year is that now we're talking about this year end rally. We're going to talk about it ad nauseum. We might get one. If that happens, okay. But then once it's over, then what? Right? That would be my concern. So we get past, okay, the year-end rally piece. If that's correct and it does actually occur. Also, what we do, I can say this because Guy isn't here today. What we do call a Santa Claus rally actually happens after Christmas, right? It actually happens right around Christmas Eve, and then the expectation is that it continues through the end of the year. So let's say that occurs. Then we get to January 1st and it's like, well, now what are we excited about? Right. So that's where the air could come out of the balloon. We've seen that happen a few years, even in the past 10 years, you've seen that happen. So, although I think it's okay to talk about a year end rally and speculate on whether or not it's going to happen, you have to also look out further as an investor and worry about not just the benefit of getting a year end rally, but how much of it could you give back in January if the year end rally was too hot?
Yeah, well, we've talked about this a lot. I mean, we had this in late 2021, right? The S&P 500 rallied. I think from the end of September, it was probably around current levels, 4,300 to 4,800. Like literally, it was just, grinding higher at a time where the Fed was hinting that they were going to start raising interest rates to battle inflation. And it was a similar sort of dynamic, Liz, where money flows were just moving into the major indices. The small caps were not confirming the new highs in the S&P 500, and the Nasdaq actually topped out late in that year. It was the S&P 500 that still saw the flows. And to your point, what do you have to look forward to when you get into January of 2024? You have the potential for, estimate revisions lower, right? And a stock market trading above the 10-year average with interest rates much higher. And then if you start seeing inflation readings start to tick up a little bit, that's the thing where maybe that golden forecast goes from being bullish to some people's minds, where you could have, not a rate, you could have a rate cut for the first time in late 2024. That gets pulled forward for not good economic reasons and therefore weighs on stocks, in my opinion. I don't think a stagflationary environment is going to be good for risk assets. So there you have it, people. All right, Liz, we covered a lot of ground here early on a Monday morning. I appreciate you being here with us, especially on the day after your Packers lost to the
Ugh.
Steelers. I know, I know, I know. That's probably what.
Somebody sent me wait, this is so cute. Somebody sent me a DM on Twitter, and it was a Steelers tweet, and they had a cheese grater. It was a picture of a cheese grater, and then a chunk of cheddar cheese that had been shredded,
Yeah.
and I don't remember what the caption was, but basically that they shredded the cheese heads. As painful as it is, I thought it was a clever post by the Steelers. I'll take it.
Whoever sent that, they had one opportunity to slide into your DMs, and that's what they did. Not particularly cool there, people. Um,
They sent an insult.
yeah, exactly. All right, Liz Young, thanks so much.